Good afternoon. Thank you very much for coming to our live webinar. If you're doing this on the Zoom call, then you can ask questions. Otherwise, this is on our YouTube channel, which is probably where you're watching it now. Today, we're going to talk about whether hiring a financial advisor is worth it. So as a financial advisor, I could be voting as a turkey for Christmas. But I think it's important to understand where we can add some value and where I think as a DIY investor, or you can do it yourself, you should. It's also good with financial education if the general population understand, or you understand what you can do with your planning and your investment portfolio, and see whether the advisor can help you at certain points. So, is it worth it? Well, the answer is, it depends. And there are 5 factors that I think we've identified. This is a Morningstar survey that they did when they looked at whether or not financial advisors do add value. So it is quite topical at the moment, and you can see whether or not you think you need an advisor, or your current advisor, you probably say, well, actually, I don't need you, I can probably do it myself. So we've got 5 different levels. The level of fees, the breadth of the advice on offer, the advisor's skill level, your skill level, the investor's skill level, and the life stage that you are at. So if we look at the first one, the level of fees, how much is the advisor charging for your services? So you should know how much it's costing you. I'm a big believer in the transparency when it comes to the advice and the cost of it. So if an advisor may charge you a percentage of assets, a recurring subscription fee, or an engagement or project, or an hourly fee, it's easy to come up with the total annual dollar outlay. How much is it costing you in dollars and cents, or pounds and pence, or euros and cents, to see whether or not how much the advice is costing you and whether or not you are getting value for that amount of money. And then also it's worth thinking about, well, how much are you going to pay every year for this? So if you're paying an hourly or engagement project, then that's not necessarily going to recur from year to year. If the advisor is charging in another way, such as a commission-based product, which is generally what happens in the rest of the world, certainly in Singapore, where you have a unit-linked life assurance product, an ILP, which the commission is based on your annual premium times the number of years that you've invested, generally up to a maximum of 25 years. That's why you get a lot of 25-year plans. And then it's a percentage of that total value, so 3% or sometimes 4.5%, depending on the relationship with the firm has with the insurance company. So you should know how much it's going to cost you. So if you think that paying thousands of dollars, tens of thousands of dollars for the advice is appropriate, then okay, that's good. There's no right way to pay for financial advice, but you should know how much it's costing you, and then the impact of that cost on your investment return. So we had a quick look at the different levels, and I've broken them down into a nice little table to understand whether or not it's appropriate for you. So if you're going to pay per hour, it probably works out well for individuals that are looking for a focused advice rather than the sort of broad range or ongoing advice. And the same with the project or engagement, where you've really just got one need that you need to be solved, and just paying this one-off fee gives you advice. You can accept the answer, and then you can get on with the rest of your planning yourself. And then you've got the other options, which is a percentage of the assets, so sometimes 1%, 0.5%. So if you're looking for ongoing advice, then this tends to be the default model that a lot of the institutions, robo-advisors, private banks, financial advisors will go down. So the more assets you have, effectively, the more you're paying, but you tend to get a lot more service for that level. Just be aware of what you're paying for it. Or there's the retainer or subscription model, which is very much like Netflix or that type of subscription model. And I think this is where the advice will end up, similar to solicitors, lawyers, where you're having a retainer or you're having that subscription, and you can dip in and out of the advice when you need to. And it's not based on your total assets under management, so it may be expensive at the lower level, and it may be cheaper at the higher level. So as I said, there's no right way to charge for advice. You should just know how much it's costing you. And then we look at the breadth of advice on offer. So cost is only an issue in the absence of value. Okay, so if you don't know what you're getting and it's costing you a lot, then you're going to feel aggrieved. But if you think you're getting great value and it's still costing you more, then you're paying for what you get. So advisors tend to fall into sort of one or three buckets, and there's probably lots more other areas as well. Managing a client's investment portfolio in its essence on its own. So this could be like a private bank or an investment portfolio manager, an IAM or an EAM, they call it here. It could be a financial advisor. They just maybe just give you advice, quarterly changes. You might find it's very transactional. So if you get a lot of turnover in the portfolio, then it's maybe conflict of interest there because they need to generate income based on the transactions. And then you get those primarily focused on financial planning. And this could be financial coaching. It could be cash flow forecasting. It could be to a degree of financial advice as well. And then obviously there's the difference between the two. So you can have two areas. If a advisor is focused on the investment portfolio, then they're not necessarily going to get involved too much in the other areas of planning, such as retirement, insurance, goal-based planning. Fees may be higher if the advisor is offering these services, so comprehensive financial and portfolio planning. So just understand where you sit and then what are you paying for. And then we come on to the advisor's skill level. So are you paying enough? Are you getting the service you want? And then can the advisor deliver the service? Are they appropriately qualified? Do they have enough experience? So a lot of advisors say they offer a broad range of financial planning services, but it depends on what you're trying to offer. What is the selection of areas, and is it actually holistic or is it actually comprehensive? So larger firms may offer this advantage because they've got some tax specialists or investment specialists or estate planners and so forth. But then the smaller firm or the small solo practitioner may be a little bit more bespoke, a little bit of better service tailored towards you. But it's understanding, okay, well, what are those qualifications that they exist? So I have the Certified Financial Planner, CFP, here in Singapore. In the UK, you'd have the CFP. You'd also have a Chartered Financial Planner. In the US, you'd have the CFP is the level that everyone wants to get to, but there are also local exams or qualifications the advisor needs to do in order to give advice. The same in Australia, CFP is there, but then also the Advanced Financial Planner is a good standard that consumers look for in that local area. In Singapore, we have local exams that we need to do, and then if an advisor has more qualifications, then it tends to be that they're more interested in giving good advice. But exams doesn't necessarily mean that they are going to be good at their job. It's the same as experience doesn't necessarily mean that they're going to be good at a job. Then you need to find the balance between them, and whether or not it's appropriate for what you're looking to do. But generally, having more exams means that you're more likely to be a better advisor than one without. I think most people could agree on that. obviously some outliers in that. And then we look at the investor's skill level. So what do you want to do, and what are you trying to achieve? So do you need an advisor? So if you're just doing a DIY investment and you're buying and selling shares, you're buying and selling funds, are you investment planning savvy? The advisor just may not offer any benefit whatsoever. It's human nature to overrate our attributes, whether it's our appearances or driving abilities. So you got to understand whether or not you fit within that level, and you know what you think you're good at, and if an advisor can help you with it. I think what we're seeing more and more now is investors saying, well, actually, I'm good at one area and I can solve it very cost efficient, but there is an area such as tax planning or some cash flow forecasting, which I just do not, I'm not as good as I think I am, or not good as I should be. So therefore I need an advisor. So that's where that hourly or a per engagement process comes into. And we have done it quite recently where we have offered the financial plan, and then the investor says, great, I can now go and do this myself. They know how to access the products they need, the funds, the shares. They just needed that extra little bit of advice. So there is a level where it sits. And do remember there is a disconnect between knowledge and action. And a lot of the areas I think we're starting to get involved in as an advisor is really the human behavior or the financial behavior that investors or people do when it comes to their finances. Investors tend to do the worst thing ever, is they come out at the bottom and get in at the top. And they continue to do that. So they're not only do they get it wrong, they get it wrong twice. So you need an advisor to say, look, don't buy that caravan park, don't buy that bamboo fund, don't buy that Woodford fund, for instance. Helping the advisor may help you in stopping you making decisions that will cost you later on. So there's a lot of it's just saying no rather than yes, or no, I don't think that will work. And that's where hiring an advisor may help you with the change. It's human behavior that we tend to have to start managing now. And we are generally moving into becoming behavioral coaches, I think, with all of the skill and qualifications of actually just doing financial planning. So depending on what your institution can offer you, if it's a bank, they may just say, just want to sell you a particular product. They offer the level of service that you want. Same with the financial advisor or an external asset management or an independent asset management firm. What are they offering for you, and are you paying enough for that? And then really life stage also makes a big difference. So we found the more assets that you have, the more advice you probably need, especially when you're coming up to retirement, where you need to know, okay, how do I de-accumulate my portfolio in order to make sure that I don't run out of money? Or you need a second set of eyes on the plans that you've done, because it's quite a crucial stage. If you're in your 20s or just starting out, then the advice may not be as great as benefit as you would think, whereas you could just save your money into quite a low cost passive portfolio and just keep doing that. And you'll probably find that you don't actually need so much value of an advisor at that stage. Or it could be a one-off project, like I need to get insurance because I've got a family. Okay, so I can just engage an advisor, say, can you just give me an insurance policy? I don't really need the rest of it. Or I need to get a mortgage, so therefore I can go to a bank and say I just need a mortgage, but I don't want the investment, I don't want the insurance planning around it. So that's where you'll find that those engagements or those per hour or project cases will come into play. Cognitive decline is a risk factor as we get older. So as we get older, people tend to say, I just need that second set of eyes. I just need someone to make sure that we're not doing the wrong thing because we've got confirmation bias or another type of behaviour, the human behaviour that comes to finances. So there is areas to think about. So wealth is the number of days you can survive without working whilst maintaining your preferred lifestyle. That's rich dad, poor dad. And this is where I think we add some value. So how do you know what this is? When we use our financial forecasting software, and you can see an example on our website, so you can download a snapshot to show, well, this is what it is. So you can tell you whether or not you will be okay, whether or not you're going to run out of money, whether your legacy will happen, how much you can spend every year without it affecting your planning. All those milestone goals that we put into kids going to uni, you helping them out, you buying houses, buying midlife crisis, we can help you out with the actual plan. And that's where I think we do add value. So it's not necessarily about my retirement is based on what I earn, it's based on what you plan to spend in retirement. So if you're not sure what that is, then that's maybe where an advisor can help you. And bad advice should not put you off from getting good advice in the future. You just need to, when you go to an advisor, go through the stages that we've talked about here and understanding what you are looking for and where your areas of expertise are missing, how much you're paying for, whether or not that advisor can offer the level of service that you expect for that price. I don't think you can recommend an investment portfolio for a client without a financial plan. I think the financial plan should determine the rates of return and the portfolio construction rather than the portfolio determine the financial plan. I think that's the wrong way around. If you know that you've got 50 years to before you come to the end of your days, then you know that you should be invested for that period. Retirement isn't generally these days a set point in the future. It's a gradual process. So your portfolio should be able to be linked to this. No plan, no portfolio. So a proper financial plan, the life plan, is something we should all put in place. And we've got a list of sort of financial goals that most people like to do. So the financial bucket, and your portfolio should always be linked to these goals and aspirations. And you got to bridge that gap between perception and reality, and that's where I think we add some value in that sense. So if you can see your financial plan and you can see it in colour, you can amend it, you can interact with it. Then you may feel that there is actually some value in what you're paying for when it comes to that level of service. So understand what your concerns are, what your dreams and aspirations. An advisor will tell you the truth about the money, tell you the truth about the portfolio you've got, or a good financial advisor will, and tell you whether you're on track, whether you need to allocate that cash, stop spending money every year, put some money away, where to take that income from across your pension plans or your retirement pots, how to save tax in those 3 different countries that you sit in. It really depends on you as an individual what you're looking for. So get a financial plan and live the life you want to live. So in summary, level of fees, breadth of financial advice on offer, the advisor's skill level, the investor's skill level, and the life stage that you're at. And I think those are the 5 areas. Obviously, there's a few other sort of subsections that we could probably go into. But if you want some more information, then please get in touch. Have a look at some of the other videos on the YouTube channel. Have a look around the website. Download the financial snapshot, see what you can get, and then get in touch if you want a financial plan, or if you think it's worth hiring a financial advisor. So thank you very much, and we'll speak to you next time.